Why in the world would somebody use life insurance to buy real estate? I mean, how does that really work and what does that actually mean? So if any of those thoughts have ever ran through your head, you're in the right place. I'm gonna do a simple breakdown of how to use life insurance to buy real estate, and I broke it down to 6 simple steps. Step 1 is to decide what type of life insurance you actually want to use. And the reason so many people are turning to life insurance is because people don't trust banks the way they used to. And that's twofold, because people don't trust the business operations of a bank, and people are not trusting the financial strength of a bank either now. So because of that, life insurance is looking like a much safer option when it comes to parking your money. You see, banks operate on what's called fractional reserve banking. So that just governs the amount of money they have to keep on reserve based on the deposit. Because legally, when you deposit money in a bank, there's a certain portion they have to keep in reserves, and the rest of it they can give out in loans. And what a lot of people were not aware of is that in 2020, they lowered the reserve requirements from 10% to 0%. Meaning now you put in $1,000, they could take that entire $1,000 and loan it out to someone else. So literally they don't have to keep anything in reserves anymore. And that's just one reason why people are looking for alternatives to the normal banking system. Now, the 2 most common types of life insurance policies used for buying real estate are whole life and index universal life, also referred to as IUL. And both of these are considered permanent policies that grow cash value. And I'm not going to go into too much depth on the details of the 2 different policies, but I will go over one of the main differences between the 2. And that's the way the cash value grows. See, with a whole life policy, you're going to get a fixed rate of return somewhere around 5 to 6% annually. So you're not going to see fluctuating interest rates. Now, when it comes to the IUL, the growth of the IUL is going to be dependent on the performance of the market. So if the market performs well, your cash value is going to grow following it up until a cap. The cap's the most you can get on an annual basis. Usually that cap is somewhere around 8 to 12%. And then there's a floor. The floor is usually 0%. That means if the market were to decline, you're guaranteed you'll never lose money because you can never go below that 0%. So that's just a quick snapshot on how the different cash values work from policy to policy. If you want more details, I'll link specific videos at the end of this video so you can take a deep dive and learn more about each product if you like. Now, step 2 of the process is actually setting up your policy. And I tell people all the time, the most important part of this is having a strong and ethical agent that knows what they're doing. Because when you have a strong and ethical agent, they'll be able to take care of everything else when it comes to setting up your policy the right way. So the first thing to do is to work with a strong life insurance company. And that's pretty easy to do because most life insurance companies are strong. You may find some with slightly higher ratings here and there, but for the most part, they have good financial backing. And again, having a strong agent will make sure that you're working with a strong, reputable insurance company. Now, after that, you want to make sure that the products you're being offered has the right loan provisions that match your time horizon. Because there are companies that offer loans starting at 30 days, and there's also companies that offer loans starting at month 13. So make sure to assess your goals and make sure whatever your time horizon is for your goal matches when the loans will be available to you. So now you got that out the way, now you move on to the policy structure. So life insurance policies can be structured 2 different ways. There could be a death benefit focus and there could be a cash value focus. For the scenario of buying real estate, in most situations, it's going to be a cash value focus. And I always teach people to look at the death benefit and the cash value as like a seesaw. If the cash value is high, that means your death benefit is going to be low. And if your death benefit is high, typically your cash value is going to be low. And the reason you want your death benefit to be low and your cash value to be high is because when you put money into the policy, you want the vast majority of the money that you put in to go towards the cash value versus being eaten up in cost, because the death benefit is something that you have to pay for. So you want that cost to be as low as possible so you can get as much money to your cash value as possible. Because again, the cash value is what's going to be leveraged when it comes to getting a policy loan. So you want that cash value to be as high as possible. Now, step 3 is funding the policy. This is the process of actually taking money out of your bank account and putting it into the life insurance policy. So once you have your policy structured the way you want it and it's time to fund the policy, you want to know what your flexibility options are with your payments. Because when funding your policy, there may be times where you want to put in more annually and there may be times where you want to put in less annually. So it's important to know what are those parameters, what's the most you can put in and what's the least you can put in. Now that minimum amount, that's what's going to keep the life insurance policy in force, because again, it is life insurance, so somebody has to pay for the death benefit. So you want to know what's the worst case scenario, what's the lowest you can put in. Now the max amount, that's the most you can put in without creating a MEC, a modified endowment contract. And creating a MEC just means you violate the IRS guidelines as far as how much you can put into the policy. And if that happens, you pretty much lose all the tax benefits of the policy. And I wouldn't say this is something to stress over, because if you accidentally paid too much to your policy, most carriers would just send you a check back because they know you don't want to MEC your policy. Now, the most common way I see people pay into a policy that's using it for real estate investing is they'll start off with a larger lump sum And then every year after that will be a smaller amount. And that's called front loading your policy. And the reason for that is because they want that cash value to be high really fast, because they want to immediately take money out of it to use it for, obviously, real estate investing. Now, if you don't have a lump sum to front load your policy, you can still do it on a monthly, quarterly, semi-annual, or annual basis. But with both funding options, you'll still be able to leverage that cash value when it comes to getting a policy loan. And that moves us into step 4, which is actually taking a policy loan. And this is another huge benefit that really attracts real estate investors. And the reason you want to take the money out in the form of a loan and not a withdrawal is because if you withdraw the money, everything above your cost basis is taxable. But if you take a policy loan, then you avoid taxes altogether. And the process of getting a loan is fairly simple. You'll complete a 2-page document, ask for your name, your policy number, how much you want. You have to sign it, date it, send it back in. And from that point, it'll take probably maybe 5 to 7 business days to get your money. If it's a company that does direct transfers, they'll transfer it right to you, but it's not a big deal at all. And depending on the type of life insurance policy you have will determine which loans are available to you. With whole life, it's going to be more of a standard fixed loan, and the average loan charge for that is going to be somewhere around 4 to 5%. Now, one important thing to understand is that when you get a policy loan, that money's not coming out of your cash value. That loan is coming directly from the insurance company. That means your cash value stays parked exactly where it's at, earning uninterrupted compound interest. So if you have $100,000 in cash value, but you've leveraged $90,000 for a loan, that entire $100,000 stays parked, earning interest nonstop. So it's giving you an opportunity to earn interest on the same dollar in 2 different places, because the money's still in the cash value, but at the same time, you have the money in hand and you're putting it somewhere else, earning interest on another investment too. And that's why real estate investors love these policies so much. Now, when it comes to the IUL, they have the same type of loan that the whole life has, but they have an additional loan where you can earn whatever the market is earning. So let's say you have an IUL and you take a loan out and the loan charge is 4%. Now with the IUL, it's growing following the market. So let's say the market does 7. So you're being charged 4, but you earn 7. So you have an opportunity to create a spread of 3%. There's not many places where you can take a loan out and get a spread on your money. Of course, this option comes with more risk because the market's unpredictable. So if the market does 2, then you're upside down in your loan for that year. The good thing is that you can switch back and forth every policy year to different type of loans. So if you're in a loan that follows the market and you want to switch it to a fixed rate of return loan, you could do that every anniversary of the loan. And as far as paying back the loan, that's completely up to you if you pay it back or not, or how you pay it back. But I always tell people, if you're trying to treat this like your own bank, you want to treat your own bank with the same respect that you treat an institutional bank with, and pay back your loan. Now, in the event you actually die with an outstanding loan, this is what's going to happen. Your cash value that was leveraged for your loan, that cash value will pay back your loan, and whatever's left over will be added to your death benefit and pay out to your beneficiaries tax-free. The second scenario is whatever's outstanding in the form of a loan gets deducted from your death benefit, and whatever's left over gets paid out to your beneficiary. And obviously you get to choose which option happens when you're setting up your policy. Now, the next part I wanted to cover is not part of the 6 steps, but is really valuable, so I wanted to make sure to include it in part of the video. And this is what's called a collateral assignment loan. Now, this will require you to do some work, but it may be worth it for you. So with a collateral assignment loan, you're gonna have to find a third-party lender that accepts collateral assignment. And what happens is you're gonna get a loan from that lender, and you'll be able to use your death benefit to secure that loan. Because in most situations, you're taking a loan directly from your own personal policy and you're leveraging the cash value. But in this scenario, you're taking a loan from a third-party lender and you're leveraging your death benefit. And the reason this is so significant is because your death benefit is larger than your cash value from day one. So the way it works is you'll get a loan from the lender, and the reason they'll give you the loan is because what you're doing is you're making that bank or that lending institution the actual beneficiary of that amount that they're loaning you. So what that does is secure the loan, because the bank knows they're going to get their money back if you were to die, because it'll be coming directly from the insurance company in the form of a tax-free death benefit payout. So it's definitely worth looking into. So you'll have to find a lender that accepts collateral assignment, and you have to be working with an insurance carrier that allows collateral assignment, because not all of them do. So now that you have cash in hand, the next step is for you to actually go out and buy your property. Now for this step, you would use whatever method you use for buying real estate. So if you do flips, you can 1031 into new properties, or you can just take the money, pay the tax, and then pay back your policy. You can do whatever you want. If you're doing rentals, you can take that rental income profit and start paying back your policy. You can do whatever you want at this point. This is the part that you control. But the goal is to some kind of way make sure you continue to pay back the loans and create your own bank. And the last step is tax-free retirement, because no matter what we're doing, eventually we get to the point where we're like, stick a fork in it, I'm done. So at that point, all this accumulation, all this compounded growth over all these years have built up, and you can now turn that policy into a tax-free retirement income stream. And this is powerful because a lot of entrepreneurs, a lot of self-employed people don't have traditional retirement plans. And if you do have one, in most cases, it is a taxable account. So this is a great addition to add to that, because this money is going to come to you 100% tax-free. And not to mention, you have a permanent death benefit that's going to last to age 121 that will for sure be part of your legacy and pay out to your beneficiary income tax-free. So that's how you use life insurance to buy real estate. So feel free to ask questions in the comments if you have any. And like always, if you found any value at all from this video, put a happy face in the comment section. Make sure to like, share, and subscribe to the channel, and I will see you in the next video.